Gold is seen as a safe go-to investment bet, and as the festive season approaches, sales of gold are expected to go up. So, what investment route should you take when you're putting your money in gold? Is it better to buy gold jewelry, gold coins, and bars, or do gold ETFs and sovereign gold bonds offer better returns? Welcome to TUI Wallet Talks. In this episode, Navneet Damani of Motilal Oswal Financial Services explains the pros and cons of each gold investment option. So, Navneet, firstly, let's talk about physical gold. What are the investment avenues if I want to get into physical gold? I mean, recently there was this report that all these monthly gold schemes are gaining traction, and not just physical gold per se, but even digital gold. And by digital gold, I mean ones where you can, buy it through some channel online, and then they store a physical gold, commensurate to the value that you have bought. So, what are the pros and cons of investing in these avenues?
Well, let's start with physical gold. Physical gold, you've got a couple of avenues. One is that you mentioned that we can look to purchase jewelry, and as you purchase jewelry, you tend to lose on the making charges of the jewelry. The second option could be you can look to invest in gold bars and coins, where there are not much of a making charge, but there is a hassle to hold those coins in your locker or in your household wherever you want to keep it. And thirdly, there are the schemes which are launched by a lot of jewelers where you pay for 12 months, you get a 13 month as free ticket, or varied scheme with different group with dwellers and different market participants. But the most trustworthy amongst the physical gold scheme, I would reckon, is buying into a physical coin or bar. Secondly, it could be probably looking at jewelry. My only apprehension is if you want to wear jewelry, if you want to flaunt jewelry, then it is making sense to invest in jewelry. Otherwise, bars and coins are a better option as far as physical gold is concerned. Now, coming towards digital option, there are a few digital options which have come into limelight over the last 4 or 5 years. One has been the sovereign gold bond scheme, which has been launched by the RBI and which has garnered a lot of attention and a lot of success. Second has been the mutual fund route, where a lot of mutual funds are getting into gold investments. Then you have schemes like ETFs, which have become the flavor of the market for the last few years, where a lot of traction has been witnessed. And we have these likes of digital market players like the PhonePe or the Paytms of the world, where you can invest through them also, and they have a backing to store some value of gold against your investment at a designated locker.
Okay, but while we will come to each of these options that you mentioned individually, if I were to go back to the ones that you mentioned about PhonePe, Paytm, and all, what are the pros and cons of investing in them?
Well, there are not much of a pros and cons. The only thing is that the regulatory framework is different from what it is in terms of an ETF or a sovereign gold bond. You have a lot of comfort when you invest in a sovereign gold bond. The only access here is they invest in physical gold. They have it backed by a large participant. It could be MMTC, PAM to extent, or some other jeweler or refiner, which could be holding value for from the money that you've invested in these assets. Against that, the physical gold is purchased. There is a 3% GST charge also, which is levied to you. So against that, I think you get a physical note or probably a contract note as a warrant that you are holding certain amount of gold in your digital locker. These are some schemes which have been prevalent but have not been very, very successful. Better, I would rather reckon that if you want to invest in these kind of format, then making investment into an ETF or mutual funds make more sense rather than these kind of digital.
Okay, so coming to gold ETFs, it's quite a popular investment option when you're looking at gold. So, what are the risks associated with it?
Well, there are no major risk in investing in gold ETF. The only risk that I feel is a kind of underperformance vis-a-vis gold prices. The charges at one point in time, management fees in gold ETFs were pretty high at about 0.8, 0.9%, but now being a very competitive market, they've been coming down to about 0.4%, 0.5%. So 0.5% a year is not much, not going to make much of a dent. It is similar to what mutual funds are also charging for investment in equity. So not really a great differentiator. So if you invest for 5%, 5 years, your returns might vary about 2.5%, or at max 3% vis-a-vis physical gold prices. And largely, most of these ETFs are pretty successful. The liquidity has been pretty reasonable. The few large players have immense liquidity. They have different denomination. They trade in 2 digits also, in 3 digits also, in 4 digits also. So you can look at the kind of investment you want, and it is in the similar format in your demat account. So you can see buy between 9:50 in the morning on the NSE platform and sell between 9:30. So the kind of liquidity or comfort it gives you is beyond anything. So I think this is a very good format and a good platform where you should be looking to invest into gold ETFs uh, through these NSE and BSE platforms.
Okay, so coming to sovereign gold bonds, they're actually seen as a very safe investment bet when getting into gold. So, what do the historical returns suggest, and what do I need to know when I'm getting into a sovereign gold bond?
Well, I was doing some calculation recently and I saw that the first tranche which was launched is giving a return of about 120% over the last 7 years. So it's an amazing return that sovereign gold bond has given to its investors. However, the question is that should I be looking to invest in sovereign gold bond now? Should these kind of similar returns be witnessed in the next 7, 8 years? Well, it's a difficult question to answer because things have changed very drastically for the macroeconomics over the last 7, 8 years, and which has been very beneficial for gold prices. So some of the key factors for sovereign gold bonds are it gives you an additional coupon of 2.5% in terms of interest, which is of course marginally taxable. To top it up, you have government backing. So come what may, whatever happens, the government is going to make good that whatever investment you've parked into sovereign gold bond comes to you in the return format along with the interest and coupons that has been assigned to you. The only challenge that I feel with sovereign gold bond is the lock-in period. So the liquidity in the secondary market, if you want to liquidate your gold, is very shallow, and it typically becomes a buyer's market because you are the seller who are already having the bond. So the buyers want to buy at a 5, 7, 10% kind of a discount to the current prevailing price, which is not really very exciting. Add-on factors is it got a 8-year lock-in, and after 8 years, the gains are pretty are tax-free, which is a very big catalyst or probably a differentiator why one should be looking to invest in gold. So one has to decide very strongly that what is the time frame that I am looking at. If it's a 5 to 8 year horizon that you want to invest in gold bond, then this is the best option which is available. But if it's a very tactical move for 1, 2 years that you want to play, then probably you could look at mutual funds and ETFs as a better option for a tactical point of view.
Okay, so coming to mutual funds, what are the advantages and disadvantages of taking the gold mutual funds route?
Mutual fund routes are kind of similar to what the ETF format is, and uh, I don't see much of a downside on the mutual fund route also, except for some smart fund manager managing your money on behalf of you, and it largely takes care of the 3% GST also, no holding cost or no holding cost that you incur for a bank locker or any kind of rent that you incur for if you want to park your money into gold. No major hassle of what kind of gold that you bought. Is it the purest form? Is it 999 or is it 915 or 916, whatever is been delivered? So that is all taken care by the mutual fund team. So, it's a good proposition where one could be looking to invest into gold from a mutual fund. But however, from a longer term time frame, as I mentioned, sovereign gold bond becomes attractive if you want to invest in mutual fund for a 8, 10 year perspective. Then it is largely going to eat into your return through management fees. Maybe at least 5% to 7% is a rate, is a differentiating factor between your gold physical market and to a mutual fund. So that is one of the negative factor. Otherwise, these are largely good investment opportunities and tools.
Navneet, coming to all the options that we have discussed, whether ETFs, sovereign gold bonds, physical gold, how would you rank these in terms of liquidity, risks, historical returns, and advantages?
Well, starting with sovereign gold bond, as I mentioned, if it's a long-term horizon that's the best bet. Along with the exact price move of gold, you get a 2.5% annual coupon, and the returns at the end of 8 years are tax-free. So it is by far the best mode to invest into gold. But liquidity is a concern. As I mentioned, if you want to liquidate in next 2 years, 3 years, you seeing a reasonable return on your portfolio and you want to exit, then it becomes a challenge. But of course, the move has to be long term in nature. The mindset has to be long term in nature if you're looking for a sovereign gold bond. Now, second would be an ETF or a mutual fund route where similar format operates. Management fees has been charged. From a tactical point of view, entry exit is pretty quick, and you have reasonable amount of liquidity to enter and exit. So that is
Okay.
not much of an hassle or challenge. So I think that is one of the route which a lot of participants are being preferring. Plus, you can do a SIP in these routes. You can have a daily SIP, you can have a weekly SIP, or you can have a monthly SIP. So every day, every week, every month, you are kind of parking some money into gold. So that is also one of the option which is available if you want to opt for ETF and mutual fund route. The digital format, they are growing at about 120% every quarter. So these kinds of investment opportunities are very lucrative, and with the digital format becoming more popular and gaining more popularity, a lot of people are now moving towards digital investments. Now, having said that, jewelry is as a store of value, as I mentioned, 3% is the GST, plus you're paying a huge amount of import tax into India, and plus making charge. So it gives you about 15 to 18% negative return immediately after you bought it. So if
Yeah.
you don't want to enjoy wearing it, it doesn't make real good sense to buy jewelry at this point in time. So physical format is not the preferred bet given the current scheme of things.